The purpose of this video is to explain the fixed asset turnover ratio. This ratio has revenue in its numerator, but it's not really revenue, it's sales found on the income statement. And its denominator, it has average net fixed assets, which is looking at the accumulated depreciation on the balance sheet. This does not include intangibles such as goodwill or other current assets such as cash or assets that will be converted to cash within the year. Net fixed assets includes things such as land, buildings, machinery, and equipment after depreciation has been accounted for. Therefore, you want a ratio that's within the industry, the norm. Let me explain. Imagine a car manufacturing company. GM and Ford both have robotics that create the cars that we all drive. Now, since our cars' technology changes so rapidly, the robotics also need to be changed out rapidly. Therefore, the robotics may only last 2 to 3 years. In another industry, such as minerals, bulldozers don't really have technological changes. They all dig. Therefore, you can have a higher fixed asset turnover with bulldozers, but you want a lower fixed asset turnover with GM. Now, these are compared to the industries. So, if you have a higher within GM, it's not great. If you have too low, it's not great. But you want a medium with GM within the car industry sector. This will explain how many times an asset needs to be replaced. It will also explain if a company is using such out-of-date equipment that it constantly has issues and needs to be fixed, or as in GM and Ford's case, if it's out of date and it cannot produce the cars that we all want with Bluetooth or whatever the new technology is for that year.